Today, the Reserve Bank Board met and kept interest rates on hold at 2.5%. The cash rate has now been at 2.5% since August of 2013. And the Reserve Bank Board won't actually meet until next February. So we're going to see this low monetary policy position for the extended period. Inside the minutes of the last meeting was also very clear that the Governor and also the Board are really keen to keep interest rates at this level, but don't have any appetite to drop them any further, even though of late there's been a bit of commentary around the Reserve Bank having more ability to actually drop rates lower. I don't think that's going to be the case. I think it's very clear that the housing problem around prices at the moment is weighing on the Governor's minds and also the Board's minds. So for me, interest rates on hold potentially throughout the whole of 2015. But again, it's going to come down to a lot of factors. Let's explore some of those factors that we're talking about. So GDP is obviously softening. We've seen Treasury over the last 6 months adjust their forecast figures for growth. That's a concern. Unemployment's going to be a concern. You know, economies like the big economy of Victoria is actually looking to slow. That's going to be a concern for the government. In terms of looking at other things like inflation, we had a good inflation number, 2.3%, absolutely good number. But what's going to happen now with the Australian dollar now between 85 and 86 cents? So we've seen that come off. In fact, in the last 12 months or just over 12 months ago, we were at parity. So that's been a big correction in terms of the dollar. So that's going to obviously mean that imports are going to be more expensive, which is going to put some pressure on inflation. But with a softening economy, what does that mean for actual real price pressures around, increases in terms of labour costs and so forth? We know the labour market's flat, so we don't anticipate any income increases in terms of real wage growth. So that's a good news story for the economy. So we're delicately poised. Sentiment's actually reasonably good in the consumer world, and we're going to see, we're seeing forecasts of around 5% increase in consumer spending over this coming Christmas period. So there is confidence out there in terms of mum and dad households, but we actually don't see the confidence in the sort of corporate area, and that's going to be a problem for us. We need to see businesses getting more confidence around how the economy is and investing back into the economy, investing back into their jobs and providing more opportunity for people to join the workforce. So it's an interesting period. I think it's going to be one where we're quite flat. Our lead indicators into the new year are going to give us some further evidence as to see whether interest rates are going to increase in the second half of next year. But for now, interest rates on hold for longer at a lower price point.